So you should be now getting conversant with the wear and tear schedule
So
in its current state. There is an anticipated amendment. In fact, it is not anticipated, as I discussed with you last weekend. The amendments have been finalized and Parliament passed. So by the time we were discussing, I said I will share with you once the president signs. Now I think next week, that will be 2nd July, I believe, around there. I will share when it is what gazetted.
Okay.
Yeah. So in the exam, we shall have to be careful in the context of the question, the timing of the question, which years, because now the amendments will matter. So the amendments take effect 1st July 2021. So now in your exam, most likely they are going to, if the question is in 2020, 2019, you will be applying the old law. But assuming you are sitting an exam in December and they have chosen to set 2021, then you would apply the recent law. But I believe for purposes of the exam of this year, we are going to use the 2020 amendments. Most likely they will use the 2020 amendments. Yeah, but then I also need to inform you, just in case you have completed the course, you are aware of the amendments.
Yes.
So I sent you the one the schedule I've just sent, that presentation material. It had a pro forma of the computation of the wear and tear schedule, which you will go through and appreciate. We said that when a person has depreciable assets, those assets are relayed in a pool of assets in class 4s, in 4 classes: class 1, class 2, class 3. Class 1 is 40%, class 2 is 35%, class 3 is 30%, class 4 is 20%.
Yes.
And we say the class 1 is computers and data handling equipments. Okay?
Yes.
What about class 2?
So we have automobiles, buses, and minibuses with capacity of less than 30 passengers, old vehicles with a load capacity of less than 7 tons,
Yes.
earth moving equipment. That's cost. Then
Very
class
good.
3, buses with the seating capacity of 30 or more passengers, goods vehicle designed to carry or pull loads of 7 tons or more.
Yes.
Trucks, trailers, and trailer-mounted containers, plant or machinery used in farming, considering or mining operations. Then class 4, we have rail cars, locomotives, document, vessels, barges, tugs, and similar water transportation equipment. Aircraft, specialized public utility, plant, equipment, machinery. This furniture, fixtures, and equipment. And the asset not included in other classes.
Yes. Then class 2, for purposes of the cost base of the depreciable asset, which is a road vehicle other than a commercial vehicle, we added on and say that the value is 60 million.
Yes.
Okay. So in the amendment, class 2 has been removed. The intention of the legislators were to remove the 35% capital allowance. So all the cars in class 2 have been
Again,
put.
you're a bit off a bit.
Pardon?
Stephen, you're breaking a bit.
No, I was
Come
saying
again.
in the amendment, the class 2 has been deleted.
Mm-hmm.
The intention of the legislators is to do away with the 35% capital allowance. And for that matter, all the vehicles have been extended to the last class, the current class 4. Yes. So there will be 3 classes. Class 1 will be 40%, class 2 will be 30%, class 3 will be 20%. Now all automobiles will be in class 3 at 20%. Yes. You are asking?
Asking now, all items in the class 2 are now in class 4.
Yes, all the vehicles in class 2 push to class 4. To class 4 at the rate of 20%. So now that class 2 has been removed, that means they are in class 3 at a rate of 20%. So the current schedule has 3 classes as opposed to 4.
Even if they say the manager, the come for the manager.
No, all of those are all of them are in class 3, which is 20%.
Okay.
Yeah. Now the ceiling of the road vehicle, I have not seen the amendment. If it has not been deleted, then it will continue to apply. So
60.
yes, even if it is in under 20% capital allowance, it will still continue to apply the cost base of a road vehicle other than a commercial vehicle. Yeah.
Okay, fine.
So what happened is that the written down value of a pool at the end of the year of income, it would be the total written down value of the pool for the previous year. You add on the additions for that year, then you deduct any disposals for that year, also for the particular pool of assets. A pool is the class. But whereas the disposal of the assets in the pool will be reducing the written down value at the end of the year, the written down value at the end of the year should never be reduced below 0. Yeah.
Okay.
Then also in the computation, if the written down value of a pool at the end of the year of income, after allowing for the deduction of wear and tear, is less than 1 million, then a deduction is allowed of that amount of the written down value. In other words, what I'm saying here is that in your wear and tear schedule, after putting in the written down value, opening balances of written down value, then you have also inserted their additions. After there, you have inserted their disposals, which are negatives, because the disposal is a deduction, reducing the amount in the pool. Then you get a subtotal. You subject it to wear and tear. Then you get that subtotal minus the wear and tear. The balance is the written down value at the end of the year.
Yes.
Now that written down value at the end of the year, if it so happens that it is less than 1 million shillings for any given pool of assets,
Mhm.
then that amount would be allowable. In other words, you take that amount under your allowable deductions on your tax computation for corporation tax.
Okay,
Yeah.
I get it.
Then there is also a scenario where the amount of the disposal proceeds or consideration you are receiving from the disposal of the any assets in a given pool happen to exceed the written down value of of the pool at the end of the year.
Mm.
Now that excess is known as the balancing charge and it is included in the business income.
Mm.
It would be taxed.
Okay.
Yeah. Then you will have a scenario where all assets in a pool are disposed of before the
Mm.
end of the year.
Mm.
In that case, if a deduction would be allowed for the written down value of the pool as at the end of the year, if the written down value
Mhm.
at the end of the year
Mm.
exceeds the disposal proceeds. In other words, what we are saying here is that any balance, any remaining balance of written down value in a pool where all assets have been disposed of should be taken as a balancing allowance,
Mhm.
and therefore it will be an allowable deduction. So the law is giving here an advantage to a taxpayer that because all assets have been disposed of and you cannot continue holding on the tax base of assets which are not there.
Mm. Okay.
So that remaining balance is allowed as a deduction.
Mm.
Because remember, when they acquired that asset, the whole capital expenditure was added back and taxed.
Yeah. Yeah.
Now it would be unfair to leave out the balance of the cost base when the assets
Mm.
are not existing.
Mm. Mm.
So yes. So what will happen is that the cost base of usually the cost base of the depreciable asset is
Mm.
added to a pool in the year of income in which the asset is placed in service.
Mm.
Now there would be a scenario where
Mm.
a depreciable asset is only partly used during the year of income in the production of income included in gross income.
Mm.
Now in this case, the depreciation deduction allowed in relation to that asset is also proportionately reduced. In other words, it would be apportioned. I had talked about the cost base of a road vehicle being 60 million.
Yes.
Now, what happens is that when you acquire that asset, let's say a vehicle, and you are treating it as road vehicle and business asset.
Mm.
So the two, in this case, a taxpayer is taken to have two categories of assets.
Mm.
You have a depreciable asset and a business asset.
Mm.
Now, the business asset, you do it would only come into play upon dispose of that asset.
Mm.
So when you dispose of this road vehicle we are talking about,
Mm.
the presumption would be that even the business asset has been disposed of. So you are supposed to apportion the consideration you have received or the proceeds you have received on disposal between the amount which relates to the depreciable asset and that which relates to the business asset. So the one which relates to the business asset, you'll compare with the cost base of the business asset. If there is any uplift, you'll add it to incomes and tax it under capital gains regime. Are we together?
Yeah, we're together.
Okay. Commercial vehicle is a vehicle which is usually designed to carry loads more than half a ton or more than 13 passengers. So that is distinguishing it from the road vehicle. Did we look at initial allowance last time?
We talked briefly. We talked about it briefly, and we say that some laws were repealed. Those who choose to
The prescribed areas.
And remained with 50 kilometers away from Kampala. That one we give every percent initial allowance.
Yeah, now the rate is uniform.
The
rate is uniform for all of the depreciable assets. So a person who places an item of eligible property into service for the first time. Now, the first time does not mean necessarily that the asset should be new. So that asset could be a used asset, but when this particular taxpayer is using it for the first time. So even if there is a taxpayer who has enjoyed initial allowance on it elsewhere, but once you are introducing it in the business for the first time, the law says a person who places an item of eligible property to service for the first time. Yeah. So would qualify for initial allowance at a rate of 50% of the cost base of the property at the time it was placed into service. Now, to take you back to wear and tear, if you are in the current law, if an asset qualifies for initial allowance, then in your additions in the wear and tear schedule, the value you would put there should be the value after initial allowance.
For instance, if you've planted a 50 million plant in Muvende, subject it to 50%, and that will be our amount put in that class.
Yes, that will be 25.
25.
After 50% would be 25 M. Yeah.
Get it.
So an item of eligible property.
But Stephen.
Yes.
Seems you have good notes. Thank you. You're telling me this one I'm seeing here.
Yeah, this one. No, I'm just trying to put them up. I did have. I'm trying to organize it. When I finish compiling, I will share. Yeah.
This one seems to be more elaborate.
I will share. So an item of eligible property, like we discussed last time, it refers to any plant and machinery wholly used in the production of income, included in gross income, but does not include three things. Do you remember them?
Come again?
An item of eligible property means any plant and machinery wholly used in the production of income, included in gross income, but does not include three things. Do you remember them?
Reminder?
We said goods and transport vehicles. Then we also said appliances ordinarily used for household purposes. And then we also said office furniture or office or household furniture, fixtures and fittings. Are you there? So in other words, that category would not qualify for initial allowance.
Sure. Mm,
Yes.
yeah, okay, okay. This one doesn't give those items. Okay. Include. Okay. I've seen it.
An item of real property means any plant and machinery wholly used in the production of income, included in gross income, but does not include goods and passenger transport vehicles,
Mm,
appliances ordinarily used for household purposes,
mm,
and office furniture, fixtures, and fittings.
yes.
So, not that every depreciable asset would qualify for initial allowance. That condition is there.
Mm,
Yeah. A person who places an industrial building
mm,
other than an approved commercial building in service for the first time during the year of income is allowed a deduction for that year for an amount equal to 20% of the cost base of the industrial building at the time it was placed in service,
mm,
provided the construction commenced on or after 1st July 2000.
mm,
So the rate of initial allowance on industrial buildings is 20%. But we are saying that this initial allowance does not apply to approved commercial building. We are going to look at approved commercial building shortly. Now, in the forthcoming amendments, still, once a building qualifies for initial allowance, then there would not be any other capital allowance in the year in which initial allowance has been claimed. That means the legislators are trying to avoid double capital allowance on a given asset. So in this case, a building which qualifies for initial allowance, you would not compute industrial building allowance in the year the building was put into service for the first time. So what will happen is that if you have computed initial allowance on a given building, then the industrial building allowance will apply in the forthcoming year. But all that I will confirm next week
Okay.
when it is fully approved.
Okay.
Now, when a person has incurred expenditure, capital in nature, on extending an existing building, that is also taken as a construction of a separate industrial building. Are we together?
Say for instance, somebody is maybe extending the water channel,
Yes, the quarters, yes.
drainage.
If they are capital works, yeah, maybe a parking yard is putting up a parking yard on a building. It didn't have a building. I mean, the building did not have a parking yard before. Now they are trying to put the parking yard, the fence, those capital expenditures. That capital expenditure would qualify to be referred to as a separate industrial building. Yeah. Okay, now industrial building allowance. Now the industrial building itself, which means any building which is wholly or partly used or held ready for use by a person in manufacturing operations, research and development into improved or new methods of manufacture, mining operations, unapproved hotel business, unapproved hospital, and or approved commercial building. So all that is the categorization of an industrial building. So when a person has incurred expenditure in any year of income on the construction of an industrial building, and the building is used by the person during the year of income in the production of income included in gross income, the person is allowed a deduction for the depreciation of the building, which is known as the industrial building allowance, calculated as A times B times C over D. Of course, A, that is 5%, then the B, it is the cost base of the construction of the building, or the total expenditure incurred in constructing the building. C is the number of days in the year of income during which the building was used or was available for use in the production of income included in gross income. And D is the number of days in the year of income. So we may have a scenario where an industrial building is only partly used by a person during a year of income for prescribed uses. This is a scenario in the question you are asking me for March 2021. They had allocated the building, I think 80%. 20% was not being used for the prescribed use.
20 was for parking space. Then the rest, I think it was for the building.
Okay. So that means the industrial building allowance would also be apportioned. Okay. You mark this, whereby if you have an industrial building which is partly used for prescribed uses, that part of the building, the expenditure on that part of the building which is used for non-prescribed uses, if it happens not to exceed 10% of the total expenditure, then the building would be taken as used for prescribed uses, wholly used for prescribed uses. Are we together there?
Come again?
If you have an industrial building, partly used by the person during the year of income for prescribed uses, and the capital expenditure incurred in the construction of that part of the building used for other uses is not more than 10%, then the total capital expenditure incurred on the building would be treated as wholly used for prescribed uses. In other words, what they are saying here, that if the building is used for other uses other than prescribed uses, and the expenditure on that part of the building whereby it is being used for other uses not exceeding 10%, then that would cause the building to be taken as being used for prescribed uses. So consequently, you do not have to apportion. Yeah. So that means when you are reading the question,
on the question, assuming it was 90%, assuming it was 10% for parking yard, wouldn't apportion?
Assuming for other uses, it is 10%.
So they wouldn't have apportioned it. They'll take it as the whole figure.
Exactly, 10 and below. 10 and below.
Okay.
Because they are saying if it is more than 10%, then the building will be taken as if it is not more than 10%, then the the building is taken as wholly used for prescribed uses. So meaning to say is that if the expenditure on that part of the building used for other uses is 10%, as you have said, you would what? You do a portion. You know?
Yes, they are not okay.
Okay.
Yes.
So 10% you don't apportion.
Yeah.
Yes. Then 10% and below you don't apportion. 11% you would apportion. So you would use the remaining balance of the percentage.
Yes.
That means it would be 90% or 80%, depending on the percentage you have been given for non-prescribed use. Then capital repairs on an industrial building would be taken as a separate industrial building. Like we said earlier that any capital expenditure is not allowable. So you add back capital expenses, capital improvements on a building, you add back if they have been deducted by the accountant, and then the building you compute the capital deduction as industrial building allowance.
Okay.
If it qualifies for initial allowance, then you also compute. The initial allowance of a building is very tricky. You need to mark it. Very tricky, 20%, and it does not apply on an approved commercial building. Yeah.
I need to read these things as well, so that they stick on my mind. When I do a number, I'm well keeps.
Yeah, now there would be a scenario maybe the building was purchased by a person and this person did not construct it. So that one, it is clear the law deems that person as having incurred a capital expenditure for constructing. Then the industrial building allowance is not expected to exceed the residue of expenditure at the end of the year of income. Now, residue of expenditure on an industrial building, that is the remaining value on of the industrial building after all the capital deductions have been effected on the industrial building. So the residue of expenditure is cost minus the capital deductions on the industrial building. So what they are saying here is that the total industrial building allowance, the industrial building allowance should not exceed the residue of expenditure at the end of the year of income. Now, when the building is being disposed of during the year of income, the cost base of that building is reduced by the deductions or the industrial building allowances allowed on that building. So if you want to compute gain or losses on disposal, the cost base of the building should be after the capital deduction on the building for the years. Now, there could be a scenario where the building is bought and sold together with the land. Now, in this case, the value of the land would be the difference between the total consideration received and the residual value of the industrial building. The intention of knowing the value of the land is that when you are computing industrial building allowance, you don't depreciate land. The land does not depreciate. So, if you have a scenario where the building has been disposed of together with the land, then you would get the total consideration received, and then you subtract the residual value of the industrial building. So that would give you the amount which is attributable to the land. Now, still, when the extension of an industrial building is disposed of together with the building itself, then the consideration received would reasonably be expected to be apportioned among the separate industrial buildings. Because the law is saying that an extension on an industrial building should be taken as a separate industrial building. So when the two have been disposed of at the same time, then the proceeds which have been received, the income which has been received, needs to be apportioned between the two separate buildings. When we were defining an industrial building, we talked about an approved hotel as also being one of the components of an industrial building. And we also talked about an approved hospital. An approved hotel is an industrial building licensed by the appropriate authorities for use at a price for boarding and lodging with at least 10 bedrooms with the minimum facilities of bed and beddings, toilet and bath or shower room and restaurant or dining room for provision of food and beverages. So that's the simple definition of an approved hotel. It is unlikely that they will ask you that, but it is good for your knowledge. An approved hospital is a specialized industrial building manned by a fully registered specialist and general practitioner for the purposes of treating general patients as outpatients or inpatients, both for medical, pediatric, surgical, and obstetric or gynecological conditions, providing treatment and nursing care, and equipped with equipment and facilities of specialized establishment. Now, approved commercial building. An approved commercial building is an industrial building which is primarily used by the owner or let out for rent for the purpose of carrying on a business, trade, or profession, as an office, as a warehouse, or commercial storage facility, or as a workshop, but does not include a building let out or used for residential accommodation. Remember when I was commenting about initial allowance of an industrial building, I said a person is allowed initial allowance for putting into use and into service an industrial building other than an approved commercial building. You recall that?
Yes.
The rate of 20%. A person who places an industrial building.
Give me a reminder. Where do we apply 5%?
5% is industrial building allowance.
Building allowance.
Industrial building allowance, which is 5% times the cost of construction of the building times the number of days the building was put in use in the year or available for use divided by the number of days in the year.
This is initial allowance on industrial building.
I mean, industrial building allowance, 5% is industrial building allowance. The capital deduction on the industrial building. So that's the depreciation of a building. It is 5%. Why it is 5% is that the law presumes that a building will have a useful life of 20 years. So that means 5 times 20 you get 100. So why I'm giving it 20 years is that you in the exam you may have a question whereby a certain building has been disposed of. So you will be expected to know when it was constructed and maybe you compute the industrial building allowance for the years to get the residue of expenditure, such that you compute either the gain or loss on disposal. Okay. So, but I was emphasizing on the initial allowance. Initial allowance is 20% for an industrial building, and this initial allowance is applicable on a person who places an industrial building other than that means except an approved commercial building. So approved commercial building would not qualify. Then the other qualification is that it should be after 1st July 2000. Sorry, second.
Okay.
So approved commercial building will not qualify, and we have just said that an approved commercial building is an industrial building which is primarily used by the owner or let out for rent for the purposes of carrying on a business, trade, or profession, as an office, as a warehouse, or commercial storage facility, or as a workshop, but does not include a building let out or used for residential accommodation. Okay. Startup costs. Now, a person who has incurred expenditure in starting up a business to produce income included in gross income is allowed a deduction at a rate of 25%. That means it is allowed a deduction in 4 years, 4 equal installments. The first year is 25%, then for the next 3 years, 25% in each year.
Okay.
So this could be initial public offering at the stock market. It could be pre-opening costs of a business, or those expenses which are not recurring, like registration, maybe the fees of an accountant, or a lawyer, legal costs, advertising, promotion, training of staff. So costs of starting a business are capitalized, but then are allowed in 4 installments. First, in the first year, 25%. So this is an area of tax planning, because for any deduction we are talking about here, it is a tax saving. Every deduction I mentioned is a tax saving of 30%. Tax saving of 30% income on incomes. Cost of intangible assets. A person who has incurred expenditure in acquiring an intangible asset with an ascertainable useful life is allowed a deduction in each year of income during the useful life of the asset in which the person wholly uses the asset in the production of income included in gross income, calculated as A over B, where A is the amount of expenditure incurred and B is the useful life of the asset in whole years. So this one is a simple calculation. They will tell you the useful life of the asset, the intangible asset, and then the cost of the asset. So the amount of the allowance is simply the cost divided by the useful life. Okay, I want to believe you are comfortable with the term intangible asset.
Yeah.
All right.
Non-current, right?
No. An intangible asset is an asset which is not physical as such. It's not a physical asset, it's not tangible. You cannot touch. Intangible means it cannot be touched. It is
For instance, patent rights,
yes, good. Patent rights, goodwill,
goodwill, yes. I'm no there.
yeah, that category.
Mm,
So if the intangible asset is disposed of by the person during the year of income, the cost base of the asset would be reduced by any deductions allowed to the person in respect of the asset. That means if you have your intangible asset in your books and you sell it off, still, like we said earlier, under industrial building or any other depreciable asset, the cost base at the time of sale should be the cost at acquisition less the total deductions which have been made under the regime of the asset. So the purpose of lessing the deductions is to ascertain the appropriate either gain or loss on disposal. Scientific research expenditure. A person is also allowed a deduction for scientific research expenditure incurred during the year of income, the cost of carrying on the business, the income from which is included in gross income. Now here you are allowed 100% of all the scientific research expenditure. Scientific research means any activities in the fields of natural or applied sciences for the development of human knowledge. And therefore, scientific research expenditure is the cost of scientific research undertaken for the purposes of developing the person's business, including any contribution to a scientific research institution, which is used by the institution in undertaking research for the purpose of developing the person's business, but does not include expenditure incurred for the acquisition of a depreciable or intangible asset, expenditure incurred for the acquisition of land and buildings, expenditure incurred for the purposes of ascertaining the existence, location, extent, or quality of a natural deposit. Is that clear?
come again?
I was saying scientific research is allowed as a deduction. The cost of scientific research is allowed. And I was defining scientific research as any activities in the fields of natural science or applied science for development of human knowledge. And we are saying that scientific research expenditure does not include the expenditure for acquiring land and buildings, does not include the expenditure for acquiring depreciable assets or intangible assets, does not include expenditure incurred for the purposes of ascertaining the existence, location, extent, or quality of a natural deposit. Natural deposit you're looking at could be minerals or oil fields. You are following? Training expenditure. Now, training, we say that as long as it does not exceed 5 years and the training is made to a citizen or a permanent resident of Uganda, then it would be allowable. The training should be made by the employer for the employee, other than an associate employer, and the income from which is included in gross income. A permanent resident, we are referring to an individual who has been present in Uganda for periods in total 5 years or more. That one is a permanent resident. So it could be a citizen or a permanent resident. Charitable donations. Hello?
Yes.
Now,
Now,
yes?
in the issue of training,
Yes.
what if let's say the manager say that the company is for like these things of like for instance the company is dealing with coffee processing, and when a guy goes to study like masters in agriculture, in line with the business, is it allowable or disallowable?
Oh, yeah, the training, as you are saying, should also be for the benefit of the employer. That means it is either benefiting the employer's business or the employee to perform to acquire skills for his or her job. So either way. So that is like the first condition. Then the next one, this person should be a citizen or should be a permanent resident. Still, when we come to employment income, I'll tell you that when you are going to tax the employee, that training as a benefit, it should not be leading to the award of a degree. Once it leads to the award of a degree, then it would qualify as a benefit and therefore taxed to the employee. Yes, I will also tell you. Yes.
If somebody, so when is it not taxable? When somebody is doing diploma?
Yes, when it's not doing when it is not leading to the award of the degree.
For instance, if somebody is doing diploma, that one is okay?
Diploma is okay, CPA is okay, ACCA is okay, certificates are okay. Degree, master's degree, all those are degrees and therefore they would be taxed.
And why would they do so?
Now that is the law. Because the law is saying that it is the training should not be leading to an award of a degree and should also be related to the person's job. So those are two conditions. Is it related to one's employment? To enhance his or her skills? If it is, then it could be what? Exempt. If it is not, then it would be still taxed. Now, what if it is related to one's employment and then it is leading to an award of a degree, like an MBA? Then it would what? Qualify for taxation.
Okay. Not in there.
Yeah. Okay. So is this okay now? Training expenditure would be allowed. The condition is that it should not exceed 5 years.
Yes.
It should not exceed 5 years. Charitable donations. The person is allowed that deduction for a donation or a gift made during the year to an amateur sporting association, a religious, charitable, or education institution of a public character. And the value of the gift. Yes?
Okay, let me first ask you something. Now, if, for instance, now, like work in Novik,
Novik?
No, I would like to. I'm trying to bring an example.
Yes.
Then we need to give some medicine to baby Sangy's home.
Sunny baby's home.
That would be allowable expense, for instance.
Sunny baby's home. And we go slowly by eliminating. Is it an amateur sporting association?
It isn't.
It is not. Is it religious?
It is. It's not.
Is it charitable?
Yes, kind of.
Okay. So if it is charitable, definitely it would qualify. Charitable qualifies. Remember when I defined charitable last time? Should be for purposes of understanding charitable or public benefit. Either should be for the relief of poverty, advancement of technology, advancement of religion, or any other purpose beneficial to the community within the legal understanding of charity. So in other words, Sun Baby's Home would qualify under relief of what? Poverty.
Therefore, we don't.
Are they
more?
are they advancing education?
No,
I don't think so.
They're offering socio because they take care of the
poor babies.
Mm.
Can we say they are taking care of the impoverished children? Then they are trying to leave them out of poverty. So we can take the first point, relief of poverty. Yeah.
Okay.
So you have to be careful with donations. Other than this, please, it would not qualify. These are the conditions, very key.
Okay.
So if they have made a donation to, it is not necessary that it should be to an exempt organization as such, but you look at this. That means even if a donation is made to an exempt organization, it is not automatic that it is allowable. No. Some people cram it like a donation is allowable as long as it is made to an exempt organization. No. It should be made to an amateur sporting association, a religious, charitable, or educational institution of a public character. Period. Nothing else beyond that. So anything beyond that is not allowable. Okay.
About the amount, you were trying to explain the amount. Should be than what?
Yes, the amount of that deduction should not exceed 5% of the chargeable income, calculated before taking into account that deduction. So in other words, the donation which is allowable should not exceed the 5%.
Now, assuming we are working in business income, how shall we put in or factor in 5%?
What some people can do is that when towards the end they can bring in donation last. In their among they can leave like a line among the additions. Then they go to allowable deductions. Then they get the chargeable income, but you can leave like a line also. Then you compute that chargeable income, but they don't write it there. They test the 5%. And so if they test the 5%, they realize that it is within, then they would what? Conclude with that. They would not, if the accountant had already deducted, then they would do nothing there. But you would have to comment about it in your workings. Now that is option 1. Option 2, because you don't want to you think you might forget, you first add back. Add back the way it is. Then after adding back, you get the chargeable income, and you realize that it is within the 5%. You come and deduct again the whole of it. So you also make an adjustment. You add back and deduct the same figure. I'll get an example and we try it together. In the forthcoming like 2 weeks. Of course, after all, we are remaining with like what? How many weeks? 5 or 4? Lockdown.
But I think Mzee will add more.
You wait, you'll see.
I'm saying things. Most likely you add more.
He'll come and say, Bananga Turumutaro.
More 3 weeks.
And you people, I appreciate Ugandans. I knew you guys, you are fighters. At least since now the vaccine is coming and several people have been vaccinated, and then we have ours which is becoming shortly to be ready. So at least to be sure, you guys, I request you be there for another 42 days. Then you come back when the situation is calm, and we.
Now say they first have to say they need to immunize everybody.
Yes,
Right.
because now that will be the debate. Immunization.
That one.
First of all, in the last address before the recent one, he said all the teachers go back to class should be immunized. But I assure you, David, by the end of the 42 days, they wouldn't have immunized all the teachers. Maybe, I don't know. If they increase the speed, well and good. But I know there are so many teachers in Uganda. Because if they talk about teachers, they are meaning teachers, lecturers, tutors, those in technical institutes.
Everyone in education.
Yes, actually now in this case it will not just be teachers. It will just be people who interact with the mass. So to the pastors, the priests, the bishops. Yes.
Everyone.
Yes, and now because they want to finish the leaders. Now when they have finished the leaders, that's the sorry, then the lead will have to follow. Those of the leaders lead will have to follow.
I tell this one will take more for 2 days.
Yeah.
Even I don't know whether she'll do CP in September. I think it'll be now in December.
Most likely, yeah, but we just have to prepare. But if they say December, don't get shocked.
Yeah. I'll be just as more ready. Yeah.
Okay, so the donation, the 5% emphasis, yeah, you don't forget it. Some students actually keep forgetting and they lose out on the marks. So if that excess of the 5% you add back. Yeah. So that means what you do here, you have the donation, add it back. When you add it back, and you get your chargeable income, but before you write it there, after writing the allowable deductions, you leave a space. Then you put the charge.
I'm still thinking. How about in implement income also the same?
For donations?
Yeah.
No. And now in employment income, you are taxing employees. Yes. So if you give an employee a gift, what the rule there is that the value of the gift should not exceed 10,000. Yeah. So under employment income is now about the value of the gift, just that. If it is more than 10,000, then it would qualify as a benefit.
Okay.
Yeah.
I get it.
So farming expenditure. Now expenditure incurred. Shortly here. Expenditure incurred by the person in farming expenditure incurred by the person in farming or who is in the business of farming is categorized. We have farm works, we have horticulture. Now for farm works, if you are in the business of farming and then you incur expenditure on plant or machinery, that expenditure would be included in the class 4, taxed at 20%. Of course, right now it is class 3 in the new amendments, which is 20% still. Farm works means any labor quarters, other immovable buildings necessary for the proper operation of a farm, fences, dips, drains, water and electricity supply works, windbreaks and other works necessary for farming operations, carried on to produce income included in gross income, but does not include farmhouses or depreciable assets. Okay,
Breaking.
I was saying, can you hear me now?
Not clear.
Yes, I was saying that farm works means any labor quarters and other immovable buildings necessary for the proper operation of a farm, fences, dips, drains, water and electricity supply works, windbreaks and other works necessary for farming operations, carried on to produce income included in gross income, but does not include farmhouses or depreciable assets. That is basically the definition of farm works.
Okay.
So when you have labor quarters, that will be which class? Class 4, taxed at 20%. Okay.
Yes.
Because we are saying that expenditure incurred by the person in acquiring farm works is included in the person's pool of what? Assets taxed at 20%. So we are looking at the 20% pool is where farm works fall.
Okay.
And then farm works, we are saying farm works include labor quarters, immovable buildings necessary for the proper operation of a farm, fences, dips, drains, water and electricity supply works, windbreaks, and other works necessary for farming operations, carried on to produce income, including gross income, but does not include farmhouses or depreciable assets. So in other words, the farmhouses and depreciable assets would be taken in the normal depreciable assets manner by computing wear and tear if they are capital assets.
Yes.
Then that means they would be falling under which class?
The what? The which assets?
The depreciable assets in farming.
They will fall under assets. Hey.
Yes.
What class 4? What class? For mining or for my class 3?
Yes, at 30%, not so?
Yes. Class 3.
Very good. And in farmhouses?
Sorry?
Farmhouses.
Farmhouses.
That is industrial building. So you would consider industrial building rules. Horticulture.
Horticulture will fall not class 4, but there is some, it includes.
Okay, horticulture. Yes, propagation or cultivation of seeds, spores, bulbs, or fungi, and propagation or cultivation in environments other than soil, whether natural or artificial. Expenditure of capital nature incurred on the establishment of a horticultural plant can also include draining or clearing land. A person carrying on a business of horticulture in Uganda to produce income, included in gross income, and has had expenditure of a capital nature on the acquisition or establishment of a horticultural plant or the construction of a greenhouse, is allowed a deduction of an amount equal to 20% of the amount of the expenditure in the year of income, in which the expenditure was incurred, and in the following 4 years of income in which the plant or a greenhouse is used in the business of horticulture carried on by the person. So do you get the difference between these two?
My book doesn't bring it clearly.
So we have farm works and horticulture. We are saying farm works, you include it in the class of 20%.
Yes.
Then for horticulture, we are saying you are going to depreciate it at 20%. So don't include it in the class, but depreciate it at 20%. So in other words, they separate you. There will be a separate line on your liable deductions for horticulture related deduction. That means it could be maybe greenhouse allowance or horticultural plant allowance. Yeah, which is at 20% of the cost.
Still in class now, I'm getting a bit confused. If you bring greenhouse, is it in also class 4?
No. It is not in class 4. Although the rate is the same, we are saying a person carrying on a business of horticulture in Uganda to produce income included in gross income and has incurred the expenditure of capital nature on the acquisition or establishment of a horticultural plant or the construction of a greenhouse. Are we together? Then that person shall be allowed a deduction at an amount of 20% of the amount of the expenditure in the year of income in which the expenditure was incurred, and in the following 4 years of income in which the plant or greenhouse is used in the business of horticulture carried on by the person. So for purposes of this allowance, horticulture allowance, you don't have to include it in the 20% class, but it is depreciated at 20%. The two are different because when you put in the wear and tear schedule, it has different implications. For example, you are mixing that with other assets. So when you don't put that, it has an implication. For instance, maybe the value of that pool of assets could be below 1 million. If the written down value in the pool of that asset, 20% class, could be below 1 million. And so to say, it would be wholly allowable as a deduction. Now, if it could be below 1 million allowable, then you happen to take there your greenhouse expenditure, you would end up raising it. And then the taxpayer will lose out on the allowance of the written down value of less than 1M at the end of the year. That is one scenario. And also, here they are giving you allowance to enjoy for 5 years. But then, if you take it to the pool of assets, there could be a disposal. And then the disposal proceeds could be so much to the extent that they raise now a balancing charge and it is taxed. You get it?
Yes.
So that's the essence. Although both of them, we are saying the depreciation rate is 20%, but the tax implication is different. Yeah. So horticulture allowance, take it that it is depreciated at 20% on a straight line basis. Not reducing balance, straight line basis. I hope you are familiar with the reducing balance and straight line basis.
Yes, they're okay.
Yeah. Is the industrial building depreciated on a straight line or reducing balance?
On cost, on straight line.
Straight line, correct. Okay. Carry forward losses.
Losses.
Now, for any of income, if the total amount of income which has been included in gross income of a taxpayer exceeds the amount, it is exceeded by the amount of deductions allowed to the taxpayer, then the amount of the excess is referred to as an assessed loss and is carried forward and allowed as a deduction in determining the taxpayer's chargeable income in the following year of income. So if the total deductions exceed the gross income of a taxpayer, that excess is what we are calling assessed loss. Now that loss is the one which is carried forward and allowed as a deduction in determining the taxpayer's chargeable income in the following year of income. So where for any year of income, the total farming income derived by the taxpayer who is an individual is exceeded by the total deductions allowed to the taxpayer relating to the production of that income. Then the amount of the excess known as the assessed farming loss may not be deducted against any other income of the taxpayer for the year of income, but shall be carried forward and allowed as a deduction in determining the chargeable farming income of the taxpayer in the following year of income. So you may have this individual who has farming business and also has other businesses and other sources of income. What the law is saying here is that if you have made a loss in farming, please don't bring your farming loss in what? In another business. Let it be there, carry it forward, you allow it as a deduction in determining the chargeable farming income for the following year. Okay, so the amount of an assessed loss carried forward for a taxpayer is reduced by the amount of the value of any benefit to the taxpayer from a concession granted by or a compromise made with the taxpayer's creditors in the course of any insolvency, whereby the taxpayer's liabilities to those creditors has been extinguished or reduced, provided such liabilities were incurred in the production of income, including gross income. So this loss could be reduced. This loss could have come up as a result of excessive indebtedness. Indebtedness may be interest or whatsoever the creditors are demanding. So if there is an agreement and the creditors have somehow forgiven you here and there, then the loss could be reduced. Hello, are you there? David, are you there?
Breaking.
Gains and losses on dispose of assets. Can you hear that?
Breaking. Hello.
I'm breaking.
You're breaking. It is hours. I know one having network.
I don't know why when it reaches this time your network goes off. I think we should adjust the time downwards.
I think we should.
How is your program during the day?
Day I normally work. I normally work up from 5. From 5 to 6.
You work from 5.
If you can make from 6.
Oh, we start at 6. Okay. 6, 7, 8. Okay. So next Saturday we shall start at 6.
6 is ideal time.
Okay.
My network is cracking.
Next Saturday, let's plan to start at 6.
Even Tuesday. Tuesday will be not available.
Tuesday I had even forgotten. No, same time, 6. Yes.
6.
Yes. We can adjust downwards. 6 like that.
Waiting for things to mature. Then I forward you something.
No, it's okay. It's okay. We are hopeful. So, are you now conversant with the allowable deductions? We are done with the allowable deductions.
We are done. However, for me, it's not say.
No, you will get. Definitely, you will get.
This one of mine is not so detailed.
You will get. It's just I wanted to fix all the information in one pamphlet. Then I share. I will.
Now basically, yeah, I can now tell what to allow or not to disallow. I think the problem would be somewhere in the industrial building, but I think when we do numbers, I will appreciate more.
Let me see. Your question bank starts from which year?
That's from 2021 to from June 2020 to December 2020.
From June 2020?
June 2010.
2010.
To December 2020.
Okay. So I want to implore you to go and check. Let me see. You go and look at December 2020.
Okay.
December 2020. That question 1. Yeah, December 2020, question 1. So after Tuesday and the Saturday, then we shall go through together.
Okay.
For corrections.
I'll go through it. Then December 2020.
2020. Question 1. You will answer. Then you can take a picture and you send.
Fine.
On WhatsApp for review.
Okay.
So I want to
the entire number. Let me see.
The first part only.
Fine.
That part which has 24 marks.
Okay.
Yeah. Then later on we shall come back to the same and we see other areas.
Okay.
Yeah. So we are going to end on gains and losses on disposal of assets. A gain is any amount which arises as a result of the disposal of an asset. The value, in which case the consideration received from the disposal exceeds the cost base of the asset at the time of disposal. And then for the case of losses, in this case, the cost base of the asset exceeds the disposal at the disposal proceeds at the time of disposal. Ways in which an asset could be disposed of. An asset can be disposed of by being sold, exchanged, redeemed, or distributed by the taxpayer. The taxpayer may just give out the asset. Okay, by way or as a gift, or the asset could be destroyed or lost. For tax purposes, that one is also called disposal, when the asset is destroyed. And also, for tax purposes, if the asset is partly disposed of, then that part which has been disposed of is also regarded as the disposal of an asset. If you have a car and you pull out an engine and you sell the engine, then you have sold a part of the asset. So if you can compute the disposal gain, then that gain would be what? Subjected to tax.
Okay.
There is what we call deemed disposal. Deemed disposal. I think we are going to end from here, so that next time when we meet, we clear the whole topic of capital gains, and we see how it moves. We are moving steadily. I'll make sure that I don't miss any. So thank you for turning up.
Oh, thank you for your time.
Continue keeping safe, social distance, sanitize. Although your job might not be easy to social distance, you are on the front line.
Ours is a bit hard to
yeah, but you can try your best.
Shall try.
I understand. Afande Kasiji the other day was posting on Twitter that there are guys who were moving with the forged travel permits, showing that they are positive of COVID. So when they present to officer quickly says, "Oh, go," because the officers don't want to get COVID. So Uganda is a very funny. So Afande Kasiji said now we opted to escort them. Once you declare results that you are going for medical review whatsoever in the hospital and you're positive of COVID, then they have a team which escorts you now to the hospital. I know it is hard. It is really hard. Ugandans are really the lives are now hard to manage, but
I tell you,
we need really to
intervene, otherwise
it is tough. Because I mean, you don't have to blame anyone. You can't say you are blaming a police officer. Well, this officer could be saving you what? Death. Maybe you are going to get the virus and die. But then at the same time, maybe when you stay home, you are going to die of hunger. Now, what do we do? It is a paradox. It is now God to intervene.
All of us now, Kampala is from people who are mostly informal sector.
Yeah, definitely.
Drivers, border, people, and they all now locked inside. They can't do anything.
Yes, some social scientist was calling it double Z, Zenkola Zendia.
Hand mouth.
That is a lesson to future leaders. It's a very big lesson, and even the current government. It is a big lesson. If it means
even ourselves need to do some saving.
Yes, savings now.
With you, because now time around, how will you begin life with it?
I'm telling you, life is tough.
The food.
Life is very tough. Whether for paid employment, whether for self-employment, you might be laughing at people who are in paid employment, but you don't know the risks surrounding your self-employment.
In fact,
you could have been a person who started the school, and you were laughing at people who said, "Ah, nze nekola byange." Now you can imagine what the losses the guys have registered over the year now.
Teachers are suffering. Teachers have suffered so much.
And even the owners of the schools,
Mm.
they are really suffering.
Some have loans.
Now, those in paid employment, even the employers are threatening pay cuts. With interest from the salary. Actually, like some employers may not pay people in July. They will say, "You guys, you are just home."
Yeah.
Hmm?
Oh.
July is now a very dangerous month. And what if he extends another 42 days?
Oh
So
God, oh God, oh God, oh God.
we just pray for rescue from
Tell you.
the Almighty.
Mm.
Okay,
And
David.
you think for Nabanja, don't know that it will reach us. Nabanja, don't know that it will
They never.
How wonderful.
My friend. Never just deal of 100,000.
Token.
Even if you say you are going to, if you divide 100,000, that is 2,000 per day. Eh? Now, Matoke,
One family.
if you have a family of 5 children, it's a lesson that you teach those children in the future to only produce one.
Oh God, oh God, oh God. We are finished.
It's tough. It's tough.
Mm.
We laugh, but
So
it's
tough, so
really
tough.
it's not a laughing matter, but we don't know. Because now, like some of us who are in towns, we even have dependents
Uh-huh.
who are in up country. So
Uh-huh.
we wait and
Phone
see.
calls are like phone calls.
We
Yeah.
wait and see.
That's true. How is Bwana Umaru?
Umaru, which Umaru?
Is it I'm calling was it Brian? Is it
Brian,
Brian?
Gerard.
Just Gerard. No,
Gerard.
no.
Sorry, Gerard is fine. He's fine.
Uh,
Yeah,
mm,
he's fine. He's okay.
try to look for him.
I last chatted with him. I think it was on Tuesday. Yeah, I've taken like 4 days. I've not been in touch for these days.
Mm,
But I think
okay.
tomorrow Monday, I'm hoping to pass by. Yeah,
Mm,
I'll check on him one of these
yeah.
days.
Eh,
Yeah. Okay.
okay, Mr. Steven.
Yeah.
Thank you.
Good night. Let's meet on Tuesday.
At 6.
Yeah, our new program is now 6.
Mm,
Okay, bye.
thank you very much.
Okay,
Good
bye.
night.
Good night.
Bye bye.